Good evening and a very warm welcome to all our viewers to the 29th edition of Cedris Knowledge Series. This knowledge series we started during the pandemic with an objective of having one speaker each month speaking on a topic related not only to finance but also health and personal well-being. We'll now play a short video of Cedris Wealth Partners. Today we have with us Mr. Rajiv Thakkar, Chief Investment Officer and Equity Fund Manager at PPFAS Mutual Fund. He started his career in 1994 and has experience in fields like merchant banking, fixed income portfolio, broking operations, and PMS operations. In fact, he has managed the PMS scheme of PPFAS with a corpus of around 300 crores. We'll now play a short video to further introduce him. A very warm welcome, sir. It's an honor to have you with us today and understanding your views about the law of the firm's farm strategy in equity investments. For all our investors, this is a moderated session where we will be asking our set of questions to Mr. Rajiv Thakkar. And in case you all have any questions, you all can post them in the comment section and we will take them towards the end of the discussion. Now, I would like to hand over to Mr. Nilesh Bajaj for taking the discussion forward.
Good evening, Rajiv.
Good evening.
And good evening, very good evening to all our viewers for the 29th edition of Cedris Knowledge Series. You all must have heard about, that equity investments is for long term. But does only long term investments help in generating returns, or there is more to it? And this is what, in fact, we would like our speaker who to talk about, who will give his ideas on constructing a long-term equity portfolio through the law of the farm strategy. Not wasting too much of time, the first question, Rajiv, I would ask you is, what does the law of farm strategy actually mean?
So the law of the farm has been coined to make things understandable by the layperson. A lot of the times, people in the financial field, people in equity investing, use all sorts of jargon, and which uh, maybe impresses a few people by technical terms, but is largely not understood by the target audience for which it is meant for. Farming is something that we intuitively understand, and the law of the farm actually found its way into our founder's writings in the articles that he used to write, or in the books that he wrote. That's where he used this analogy of the law of the farm. So let's start drawing parallels. So in law of the farm, or whenever you are doing farming, you typically plant a seed, you fertilize things. That thing has to be done at the right time. So the planting season has to be when things are opportune for planting the seeds, and you have to harvest when the time is for harvesting. You can't do it the other way around. You can't start sowing seeds after the monsoon has come and gone. It has to be done prior to the arrival of the monsoon, for example. So all those kind of things have parallels in the field of equity investing as well. So let's take seeds. Good quality seeds will result in, other things being equal, better kind of output. So I would equate that with good quality management. Good quality management, good promoter quality will result in good equity returns. But that seed has to be sown in fertile and appropriate soil. You can't plant a good quality seed in hilly terrain and expect a good quality output. Same way, good quality management also has to be tied in with uh, good business characteristics or good industry segment. A same business house may do exceedingly well. Let's say Tatas have been very successful in their IT services company TCS, and they have not done so well in, let's say, telecom, for example. Now, in one, it's not a capital intensive business, return on equity is high, and various other characteristics. In other segment, is technical obsolescence and various things. So I'm not commenting on the current prospects of either of the two companies, but just to illustrate the point that uh, the same management can be successful in one business and can fail dramatically in another business. So again, the UB Group, for example, was successful in their alcohol business, but airline was extremely competitive and they made huge amount of losses in the airline business. So the business quality also matters. So again, coming back to the farm, the soil quality also matters. You cannot plant a good quality seed in hilly terrain and expect good quality output. Just like a farmer nurtures the crop, observes the crop, uh, and to eliminate weeds if they come along, or to apply pesticides along the way, or to keep pests away. So you have to monitor your portfolio investments after uh, you make investments. You can't just ignore them and assume that everything will just automatically be fine. It has to be monitored. You don't have to stress yourself out, but some amount of monitoring is required. After planting the crop, you cannot expect output the very next day. So it has to go through its seasons and cycles. And depending on the crop, sometimes you get output in 6 months. In some trees, they take a very, very long time for you to get the fruit of your effort. So if you plant a mango tree, you may not get mangoes within a year. It will take a few years for the tree to grow and start giving you the results. And despite all this, despite selecting good quality seeds, despite selecting good fertile soil, despite planting the crop at the right time, despite giving proper fertilizers, removing the weeds, applying the right kind of pesticide at the right time. Sometimes the crop will not be to your expectations. If there's a storm, or if there's a adverse climatic event, probabilistically, uh, in many of the efforts that you do, most will be successful, but some will fail purely on account of chance, even if you have done things right. So, similar is the nature of equity investment. Uh, when you are buying equity, you are partnering with the promoters, management of the company for the longer term, and to participate in the profitability and growth of the business. That takes time to play out. So what we recommend is that don't expect anything in the short term. Invest in uh, shares or equity funds only if your minimum investment horizon is 5 years or longer. Don't excessively concentrate in one company. So we saw or we discussed about crop failures. So despite all your efforts, some crop may fail. So invest in a basket of well-run companies. So probabilistically, something will work out. But at the same time, in a particular 6 month period, in a particular year, or even 2 years, sometimes things may seem to be not going your way, but you have to stick to the process. So uh, many a times what people do is they ascribe faults for uh, things which are otherwise fine. So as I said, even a good quality seed may not succeed because of various other reasons. So people will ascribe fault to that seed, and they'll, from a high quality seed, they'll move probably to a poorer quality seed. That is to be avoided at all costs. So if for a short period of time a well run company or a company with good management is not doing well, but some other bad quality promoter seems to be doing good, it doesn't mean you change your investment process. Investment process has to be constant, and you have to live through that, uh, live through those seasons and the outcomes.
Okay, so what I can understand is that selecting the right company, the right management, uh, and selecting the right business is something what is in our control. What is not in our control is the, like, what I think, you can compare with the is the weather. You cannot compare, when the rains are going to happen, and that is what the markets are all about, that the volatility will always be there. And
Yes,
that is something which is not in our control, but definitely buying a good business is in our control, in fact.
yes. And the buying at what valuation is in our control. So I mentioned about planting a seed at the right time. Now,
Hmm.
for farmers, it's relatively easier than equity investors because they know the time to plant a seed and it doesn't change from year to year. In
Hmm.
equities, unfortunately, uh, you just have broad guidelines. Like Mr. Buffett has said, be greedy when others are fearful, and be fearful when others are greedy, or buy when valuations are low, sell when valuations are high. So
Hmm.
that's difficult. So people typically get it wrong. The best thing is to buy when there's panic in the market and increase your equity allocation. If you cannot do that, or if by your very nature of your employment, or if you are a professional, you get regular income, then invest via systematic investment plans. The worst thing to do is to keep accumulating money and rush to invest when past 3 5 years have been good and when valuations are excessive. That's actually a harvesting period. So don't get that piece right. Either invest every month regularly in a disciplined fashion, or invest when increase your investments when sentiment is very very bad and valuations are very attractive.
No, wonderful. And as in fact, we have seen from your schemes, but we always say returns speak more than just the basically the words. That a lot of invest fund managers, they give great presentations, but in the end, the schemes don't perform. But what we have seen in your case is that the returns have been very good, and I think that is sticking to the strategy which you have just ascribed to. In fact, just what you have just mentioned, uh, and that's the reason why I think you have received a lot of inflows purely on performance. Okay, any specific comments on how do you actually run the schemes, the strategies in Parag Parikh?
Sure. So I'll just talk about the returns and the investor preferences and things like that. So people who are approaching the equity markets for the first time, for them the brand matters quite a bit. So they will be draw more comfort from let's say a bank they have known for many many years, or a corporate house brand name that they are very familiar with, that brings in a certain level of comfort, which we did not have when we started off almost 10 years back. Once people have been in the equity markets for a while, then they realize that what matters is the discipline and the system driven approach, sensible investing, and then they get familiar with uh, the financial media or the portals who do comparisons across schemes, and then they start tracking the various returns, and especially in the longer run, people who have been able to manage the drawdowns when market is bad, and have managed to give decent returns across the cycle. So initial 5 years were a gestation period for us. So when we talk about the law of the farm for investors, it was law of the farm for us as an organization as well. So
Right.
initial period is just about getting your credentials right, to be able to win the trust of the investors, and uh, portray by behavior, because as you mentioned, words are cheap. It's really the behavior that counts. So fortunately, we have uh, started getting noticed of late, and that has resulted in the inflows that you alluded to. So, what do we do to uh, what do we do in our investment process, or in the journey that we have had over the past 10 years? Largely, what we have said is we are driven by the characteristics I spoke about: the promoter management quality, the business quality, uh, the valuations that are there, and some other things like whether they use excessive leverage or not, and are there entry barriers and things like that. Once all these factors are taken into account, then we don't worry too much about uh, the headlines at a particular point in time. So, be it demonetization, be it interest rates rising, interest rates falling, COVID coming in, not coming in, general elections being there, or state elections being there. All this is very, very noisy. So, if today we are in uh, April of uh, 23, if we look back 5 years, we would be in April of 2018. Now,
Mhm.
in this 5 year period, if someone said that I'm an equity investor, I will invest for 5 years and more, COVID has come and gone. That person could have slept through the entire cycle where the world panicked, where markets crashed and then recovered smartly. And someone who would be waking up today after a 5 year sleep would not even know what the fuss was all about. And in that same period, you had cycles where people were talking about interest rates coming down and interest rates going up and things like that. So, IT demand being strong and IT demand being less, and earlier people were worried about attrition, and now they are worried about margins and things like that. So all these things come and go. Largely, you have to focus on what is called signal versus the noise. Or if you are sitting on the beach, you worry about whether you are going into a high tide or a low tide, rather than focus on each wave coming in and going away from you. So that's essentially what we focus on.
Mhm. I'm not sure, but I think you were the first fund house to introduce foreign equity in a flexi cap scheme. Uh,
Uh, so when we launched, the categorization of schemes had not yet started. Uh, so at that time, these 16, 17 categories that SEBI introduced, those were not in existence. So uh, the India Plus overseas was not very popular. Maybe
hmm,
one of thematic funds had that thing. Maybe some pharma funds or some technology funds had that thing, but it was not a mainstream thing. In terms
right.
of mainstream investing, I think we were among the early ones.
Because I think successfully you have run that strategy of having international, investments as well as domestic investments, and along with the returns which you have generated. In fact, uh, now my next question: how do you research stocks? Do you have a team to research the foreign equity? Because that I'm sure is a tougher job than domestic equity. Okay, where we are based out of.
So I have been something like a broken record. I've been saying the same thing for about 10 years now. Is
Hmm.
that increasingly we live in a connected world, we live in a globalized world. Today, there is not much of a difference between Indian companies and foreign companies. Many a times, the Indian companies have gone and acquired foreign companies, so they are actually the holding company for some of the international businesses. Many a times, their uh, customers are outside India, so they are subject to the same up and down economic cycle. A lot of sectors where the production and sale may be in India, but the prices are determined globally. So I'll give
Hmm.
you examples. Now, a Tata Motors, also, although it is listed in India, is a owner of Jaguar Land Rover, which is most of its business is in developed markets. So it's subject to the same ups and downs of the auto industry in the developed countries. Uh, Bharti Airtel has African operations, or Hindalco would have investments in Novelis. So that way, we are uh, having global subsidiaries. If we look at the IT sector, the Infosys, TCS, Wipro have the same business model as a Accenture or Cognizant, where their customer base is in the US or in Europe, maybe, and most of their development staff is in India and other low cost countries. So, largely the business model is the same. And in fact, analysts only coming out with reports on TCS, Infosys, Wipro, HCL Tech, they will also be on the conference calls of Cognizant and Accenture, and they will try and draw cues on the demand over there and demand supply situation and things like that. ONGC is subject to the same crude oil price dynamics as, let's say, ExxonMobil or BP. So increasingly, these lines are blurred. So you asked about how do we research these and what is the process. The research team in our company is structured on sectoral lines. So the same person tracking oil and gas would cover both global companies and Indian companies. Same pharma analyst will again track global companies, Indian companies, IT services. So that's how we do research. And apart from our own team, we are also serviced by a lot of brokerages who send us their equity research and all that, which sometimes we use as a starting point to dive deeper into those.
Mhm. Wonderful. In fact, your trips to Oman, I think, are they continued, or because I think every year diligently uh, the Oman AGM used to be attended, and I think your value strategy comes from there. So something,
So
yeah, please.
yeah, so in COVID period, of course, there was a break in terms of the physical events. The uh, event itself was held on Zoom calls and in terms of streaming. This year, of course, the physical event is back after a break. But luckily, they have started streaming the meeting live. So this year, I am not there for the physical event. Uh, yeah, but otherwise we used to be pretty regular uh, attendees, and at that time there was no online streaming of the meeting. These
Mhm.
days, usually we catch up on the online streaming live.
Right. I think like what you mentioned, the world has become a smaller place actually, and you are better connected post the lockdown or post COVID. In fact, your style of investment is more of a value style. It's a value style of investment, and I guess till 2019, it was a growth style which apparently was doing well. You had investments with high P's, high where which were growing fast, where there was a lot of interest. But what I have seen with your track record of 10 years, your schemes have yet delivered great returns in spite of having a value style. So could you elaborate a little bit on this, value versus growth, and how does the value style actually work for you?
Sure. So the style of investing that we have, I would not call it a anti-growth kind of style. It's a style where we are mindful of the valuations that we pay. It's not necessarily that we are seeking the cheapest company which is out there.
Hmm.
So, for example, in our portfolio, you will find a HDFC Bank, which or HDFC Limited, which will become HDFC Bank. It's
Hmm.
not the cheapest financial stock around. So, if you look at in price to book or price to earnings, there would be far cheaper names which are there in the listed space. We also own companies like Google, Amazon, Microsoft, which otherwise would be some would call as growth stocks.
Hmm.
What we don't own is we don't own some of the newer listings where currently there's not much cash flow. Some of them are reporting losses, where entirely it depends on the future path to profitability. Or currently we don't own a lot of the consumer staple names or FMCG companies as they are called, where earnings multiples are 70, 80, 90, or 100 in some cases, where the valuation is excessive.
Hmm.
We are not buying very, very cheap, statistically cheap companies where the only uh, driver is a low price to earning ratio or a low price to book or a high dividend yield. These things matter, but they have to be seen in conjunction with the promoter quality, with the business quality. So it's one among the three things that matter. It's not the only thing. So you need a right mix of uh, management quality, you need a right mix of business quality, and you need the right valuation. So again, as an analogy, we have been terming this as trying to get a five-star meal at a UDP prices or at a discounted prices, rather than buying absolute street food where sometimes the hygiene may not be that good, or where you have to stand on the road and have your meal. So it's trying to buy uh, decent quality companies, growing companies at uh, below average valuation multiples.
Right. Wonderful. Actually, the foreign equity part, which I think you have about 17% right now of the FlexiCap portfolio, at least. Uh, uh, there, I assume that, that was one of the reasons why your returns were also very good in the last the initial 7, 8 years, because you picked up stocks, which apparently grew much faster than the Indian stocks. This is what we assume. But any comments on that?
So, a surprising thing for most people is that our Indian stocks have done better than the foreign stocks in terms of the contribution to overall returns.
Hmm.
The foreign stocks have done better than the Nifty 500. So, broadly, they have also beaten the index. But just as a comparison between foreign stocks and Indian stocks have done better for us.
Okay. Okay.
And apart from the flexi cap, we also run a tax saver fund where we can only invest in Indian stocks. So
Right.
that has been around for last around 3.5, 4 years, and you can see the returns. It's been more or less in line with what the FlexiCap does. So, foreign stocks are good for availing of opportunities which are otherwise not available here, or for reducing the portfolio volatility because you get some additional diversification.
Mm-hmm.
but returns more or less have been in line.
Mm-hmm. Okay, wonderful. Uh, I wanted to ask you one more thing, and this is more to do with your schemes. You've been successfully managing the flexi cap and even the long-term equity, the ELSS scheme. Uh, but in spite of the success, you have not launched too many schemes. When the going was good, we have seen fund houses launch multiple schemes, and you have those gaps from the. I'm sure from the regulator, it is easy for you to go and approach and get schemes because you do not have them as a basket. Any specific reason why you have restricted your number of schemes in the Parag Parikh basket?
Sure. So what happens is many a times uh, the research and investment team is the same, and if you have multiple schemes offered to unit holders, there's a very big overlap between the stocks that you see in different schemes. So we did not want to do that. If we have an opportunity, we'll avail of that opportunity in the single strategy that we run across the FlexiCap and the tax saver fund. Uh,
Mm-hmm.
it's not that a stock is good for FlexiCap, then it won't be good for the tax saver fund. So we'll buy it in both things. Tax saver was launched purely because ELSS benefits were not available in the FlexiCap fund. But otherwise, having a flexi cap and also having a multi cap and also having a large and mid cap and slicing it and dicing, we felt wouldn't really add too much in terms of value to the unit holder. Also, earlier long term capital gains were tax free. Now there is a 10% tax. So each time a client shuffles from one scheme to the other, they end up paying capital gains tax. So whatever purchase sale decisions need to be taken, let us say uh, at some point in time mid cap is looking very attractive, we
Mm-hmm.
can increase mid cap allocation in the flexi cap fund. If
Mm-hmm.
mid caps are looking overvalued, we can reduce the weightage over there rather than having the client to keep shifting between the various schemes. So, since our early days, we have been saying we would launch a scheme only where we would be excited to invest in that scheme along with other unit holders, or where we see a clear gap in our offering where a certain need is not being addressed. So, uh, there are certain gaps to my mind in the offering. So, at least for now, arbitrage funds are uh,
Mm-hmm.
better in terms of post tax returns as compared to liquid funds for individual investors, at least who are in the higher tax bracket. And recently, changes have been made to taxation of debt funds.
Right.
As a consequence of these changes, earlier people were keeping the equity and debt investments in separate buckets or in separate schemes. So they would have equity only schemes and they would have fixed income schemes in their portfolio. Going
Mm.
forward, I think there may be some shift towards equity plus debt hybrid kind of structures. So that we are evaluating some options. If we think that there is some gap in the portfolio and if something needs to be launched, we may have one or two schemes coming. As of now, nothing is finalized. We'll just look at that. But otherwise, we don't want to clutter the offering too much and have multiple schemes running. We would rather have fewer number of schemes and try and run them well.
No, and I'm sure the flexi cap, in spite of just having one offering, and what you very rightly mentioned, the fund manager has the flexibility to get into mid caps, small caps, large caps based on his analysis, than to try to have a pure mid cap scheme or a small cap scheme, which just increases the flavor. But in the end, it is detrimental for the investor because he pays higher tax when he moves out from one scheme to another scheme. That's so true. And Very unlikely we have seen this, with most of the other fund houses. I think that is something which is unique to your fund house, in fact. Uh, Now, coming to, an overall market, what is your basic expectation, or what is your view on the Indian markets and the US markets going forward? Seeing the last 1.5 years, we have not seen, we have seen more of a time correction in India and a price correction in the global markets.
Uh, so 2000, uh, maybe 3 to 2023, over last 2 decades,
Hmm.
we have seen a continuous uptick in equity valuations. So we don't realize these changes because they are small changes, but those small changes over a long period of time have resulted in a overall valuation creep in equity valuations that we saw. So 2003 was when I started my professional equity investing career, and at that time Nifty was maybe 12 times trailing earnings, and that has now doubled or more than doubled over the last 2 decades. Now, I'm not saying it's necessarily a thing for panic or something is imminent, but a lot of this valuation increase has been on the back of exceedingly low interest rates the world over for a long period of time. Now, that cycle seems to be turning or has turned. So, we will eventually see some kind of mean reversion over there. See, over the longer term, equity returns have mirrored the nominal GDP growth in most countries, where nominal GDP growth somewhere or the other translates into corporate profit growth and also the equity returns. So, as such, we are well placed. Uh, Economic growth can be anywhere 6% or thereabouts. Inflation can be 5-6%. So 12% kind of nominal GDP growth, corporate profit growth, equity returns should be there in the longer run. Uh,
Mhm.
it's just that near term, given the overall tightening scenario that is there the world over, things may be a bit cautious or a bit subdued, which we have seen in the last 12 odd months, 12, 18 months. So I think that may continue for some more time. But broadly, I think for equity should be part of everyone's asset allocation, especially if the money is 5 year plus. If the money people require in next 1 year, 2 years, I would think debt is a better place to be in.
Mhm. Uh, do you feel we are sitting in one of the best performing markets for the future? Uh, uh, what is your this thing on India, view on India specific?
So increasingly, as I mentioned in the earlier remarks, I think we are in a connected world.
Mhm.
So just because India's growth is higher doesn't mean that Tata Steel or a ONGC will get different prices for their steel that they produce or the crude oil that they produce. And how much ONGC can produce is governed by geology rather than the uh, economic growth rate of India. Uh,
Mhm.
TCS and Infosys and HCL Tech will have to depend on demand from Western countries, and they just because India is growing well, they cannot just in isolation keep growing. So increasingly, we are in a interconnected world, and I don't think things will be very good only for India. I'm
Mhm.
overall a optimistic person. Uh,
Mhm.
5 years out, 10 years out, economies will be much larger, corporate profit pool will be larger, uh, equity prices will be higher. So I think both will have potential. And also, many a times, what happens is you have to really look at the opportunity. So while overall India's economic prospects look very, very good, but let's say everyone is excited right now about artificial intelligence and the consequent impact on automation and work. Now, if you want to invest in that space, the Microsofts and Googles and Amazons of the world are not in India. They are listed
True.
outside India. So, uh, yeah, I'm not a big fan of picking and
Hmm.
choosing just one country over the other. I would rather invest wherever the opportunity is.
No, I'm sure, but for a typical Indian investor, India is where he will be comfortable with, and rest he will invest through, something like a Parag Parikh FlexiCap, which has global allocation. In fact, because that is something which a normal investor will not understand. In fact, the perspectives are very candid. In fact, they were something which we have not heard from a lot of our other speakers, and it was really wonderful. Any closing advice you would like to give to our viewers?
Sure. So there was a time and regime in under income tax where uh, playing musical chairs was not harmful to you. So in bond funds, you would get indexation benefits and long-term capital gains after 3 years. In equity, taxation was zero at some point in time, and people would shift from one scheme to the other, one asset to the other all the time. Increasingly, a low churn investment strategy will be much better. So think about where you want to stay put for the next 5 years, 10 years, and withdraw money only when you need it for consumption rather than continuously tinkering from one investment to the other. So uh, if you don't sell your shares, then obviously there's no realizable capital gains and no tax to be paid. If you are all the time shifting from something to the other, then it's actually harming your wealth creation.
Definitely. Thank you very much for your for this such a enlightening views on the equity markets, as well as on the law of the farm strategy which you mentioned. I'll hand over now to Unnati for the closing remarks, and any kind of questions which the audience has. Unnati.
Yes, sir. That was a very intriguing session, sir. Thank you for demystifying the law of the farm strategy in equity investments, and the analogy which you drew of the crop science with the equity investments has given all of us a very differential perspective. Moving to the audience Q&A, my first question to you is, what is your near-term outlook on the banking sector? Many reports and experts say that the banking sector has seen the peak now. So, what are your views on this sector, sir?
Sure. So, in the financial space, where let's say a non-banking finance company will raise money by way of fixed deposits or debentures and then onwards lend money, as compared to that, banks are very uniquely placed where they have current accounts on which they pay zero interest to the depositors and savings account on which interest rates are lower. So in environments where interest rates are very very low, they do not benefit much from these low cost deposits that they have. But when rates rise, they are able to earn a higher spread uh, on their low cost deposits, which are called current account saving account balances, or CASA, as uh, is known in industry jargon. uh, in India, again, we have had opening up in various sectors post 1991 liberalization, but banking space is still a place where you can't just come in and start a bank. Licenses are very tough to come by, and only a small set of companies have really achieved scale and uh, efficiencies, technology efficiencies, branch network, and things like that. Other competitors are still in the PSU space. Uh, Banks a few years back had a lot of problems on their balance sheets, so those uh, non-performing loans have been cleaned up. Currently, the balance sheets are looking very, very good. So I would think that banks are very well placed. Uh, in terms of the clean balance sheets that are there, the environment that is there, and we own quite a bit in the banking space as investments.
Absolutely, sir. Moving to the next question, you were mentioning about the foreign equity investments. So, what is the criteria that one should decide between allocating funds in the Indian equities and foreign equities?
So, in academic research in behavioral finance and other studies that have been done, there is something called a home country bias, where we invest in the country we live in because we are familiar with those companies. We ignore better opportunities elsewhere because those companies may not be as well known to us. So, just as a perspective, Indian economy as a percentage of global economy, even if we take purchasing power parity, would not be more than 8%. In dollar terms, it may not even be 4%, or it could be about 4 5% max. So, more than 90% of the global economy is outside of India. So, if you want a truly diversified portfolio, maybe only 10% investment should be in the Indian markets. But obviously, no investor will have that kind of a portfolio. Today, the situation is most people have 100% of their assets and investments only in Indian stocks. So, I would suggest people at least make some kind of a beginning in terms of having some global diversification in their portfolios. It's becoming increasingly difficult day by day. So buying direct stocks has become difficult with the 20% tax collection at source on LRS. So if you want to invest 100 rupees, you have to keep aside 120 rupees. 20 rupees you have to pay tax collection at source, which you can claim as a refund in your tax return. So that is one hindrance. Uh, in the recent budget amendments, apart from debt funds, even international funds have been hit. So you won't get long term benefits and you will not get indexation benefits. So uh, whenever the redemption happens, it will happen at the marginal tax rate of the investor. So it's become difficult to invest abroad, but I think nevertheless people should make attempts in whatever manner they can.
Right, so absolutely. Uh, Moving to the last question, which I would like to ask you from the audience is, what is your near-term outlook on the Indian mid-cap companies? Many have shown some big price corrections. Can we expect them to outperform this year?
So mid cap space is very difficult to make general calls where one predicts the mid cap indices or overall direction of mid caps. In mid caps, always the investment has to be stock specific rather than uh, overall as a category. Uh, Despite that, if we look at the price correction that you refer to, price correction has been steeper in mid caps as compared to the larger companies. But you have to also see the starting point. So the run up in mid caps also had been faster than the larger companies, and hence the correction looks steeper. But overall, I don't think there is distressed valuation kind of level in the mid cap space. Some of the better run mid caps are still at average or above average valuation multiples. So I don't see a merit in just going gung ho on mid caps and making a prediction in that manner.
Right. Uh, that was it from my side, sir. Thank you so much for making the time to grace this event and for your valuable inputs. And on behalf of Cedrus Wealth Partners, I would like to thank you, sir, and PPFAS Mutual Fund for arranging this event. Also, I would like to thank all our viewers for tuning in and making this event a success. We will return next month with a new topic and a new speaker. Thank you once again to all.
Thank you for the opportunity.
Thank you, Rajiv. Have a good weekend.
Thanks.